What's up, everybody? It's John McLaughlin with AJ Shaluga Enterprises, doing a video for y'all tonight. I'm actually going to do two videos. This is actually my second go around on these videos. I briefly posted this first video. I don't know if you happen to see it. I took it down because my audio was messed up, and it turned out there was no audio on the video. So I'm gonna take two on these videos, and hopefully this works better. The first go through on the first video ran about 47 minutes, so I'm gonna try to be as thorough but a little bit more concise so that we can hopefully keep it a little bit shorter. But you know, I don't want to cut out any information, but I'll try to be a little bit more concise. This first video is going to be on the 4 stages of the market cycle. So we're going to talk about what that is, look at an example, and some concepts to go along with it. So with that said, we'll jump right in. So the 4 stages of the market cycle. This is a cycle that all markets and stocks, all markets and individual stocks go through. And it basically consists of 4 stages, as you see here: stage 1, stage 2, stage 3, and stage 4. This is kind of the most simplistic, basic example I saw. This is just a Google search of the 4 stages of the stock market, or 4 stages of the market cycle. So stage 1, you have accumulation, which is basically kind of a consolidation phase where you have mostly sideways trading. Okay, that's stage 1. Stage 2, you have your uptrend or markup, where you have a significant move upwards. As this shows you, best time to buy is at the beginning of a markup or uptrend. Okay. This is because, particularly when you're trading, you know, a lot of people try to time the bottom or get in at the cheapest price, etc. But that can be tricky. Timing the bottom or getting the quote-unquote best price can end up with you, sitting in a kind of holding pattern, waiting for things to happen if you buy in this range. Particularly with option trading. Okay, with stock trading, you know, it might be a little different if you're dollar cost averaging and you're just buying at regular intervals, or if you're value investing and you're looking to buy things cheap. That might be different, and buying here might not be as big of a deal. But when you are, you know, looking to create income, or looking to create, you know, bigger, faster returns, or in our case, particularly trading options, you don't really want to get caught here, because you could get stage 1 can take, you know, it could be weeks, it could be months, theoretically it could even be a year or more sitting in this stage. So, you know, if you enter in this area, you could end up waiting, having your money not doing a whole lot, waiting for the uptrend to start. Okay, and so particularly with option trading and trend trading, you really don't want to sit in this stage. You want to get in on this stage. Okay, and it's more important to enter at the right time as opposed to the quote-unquote best time. Buying here might be the best time to buy theoretically, but number 1, you don't have confirmation that you're in an uptrend, and number 2, you don't know how long this next period is. This could be weeks, months, or even a year here, waiting for the uptrend to start. And so when you're trading, not investing, when you're trading, you really want to make sure that you have confirmation you're actually in an uptrend. Okay, and it doesn't matter if I buy here or here or here, I'm going to make a significant return if I'm truly in an uptrend. So stage 1 is the accumulation, stage 2 is the uptrend, stage 3 is you have the top and distribution, which is basically kind of another sideways type of phase, and then you have your downtrend, your markdown, which is the pullback, the real true pullback. Obviously you have pullbacks all throughout this. The downtrend is a real long-term pullback. Okay, and then it starts back over, Once it finds a bottom, you enter the next stage one, the next accumulation phase, and the cycle starts over again. So again, this is kind of the most simplistic view of what the cycles. We'll look at a couple more examples, and we'll look at a real chart. This gives you a little bit better view of things in terms of how it might actually really look. You know, here you have an accumulation phase, but you have a big pullback here, or you know, a more significant pullback, but you see it's stuck. As they demarcate in these blue lines, is range bound. It's stuck within this range over this time period. Okay. Then you have the breakout above your previous range. Again, you have a pullback here. So even in the markup phase, you'll have pullbacks. It tests this previous level here that we had with our in the accumulation phase, and then it has what they call the mid markup. I'm not going to, you know, I don't necessarily use these terms mid, early, late markup, but this is their, you know, terminology for it, and it makes the good point that it's not as quite as straight lined as that first example. It's not going to be straight lines. You're going to kind of have fluctuations even in each phase. In each phase of the cycle, you'll still have fluctuations in that stage. So you have your accumulation here. This is all markup here. They have it broken up between early, mid, and late. Then you have your top. You see here, even in your top, you have pullbacks and a pushback up to the top. Isn't able to break through. You see more kind of stagnation in a range, and then you have your decline. Okay, and then the cycle would start over. One more example. This is an actual chart of the SPX, S&P 500, and this is actually looking at two complete stages, actually a little bit more than two complete stages because it gets into the third stage. But you have your stage one base here, sideways trading mostly, your breakout here where you break out from that base, and we'll talk about this, but you see there's actually a base here. So there will be bases on your markup phase. You'll have multiple bases depending on how strong the stock is. It could vary in how many bases you'll have, but even in the markup phase, you'll have what we call bases, where you kind of enter a sideways zone. So this is a monthly chart, as you see here. So each one of these candles is a month. So as you see, this little range here doesn't look that big in the grand scheme of things, but this is, you know, about 8 months where it's mostly sideways. And if you're a short-term trader, definitely, you know, there's money to be made in these moves here. But we want to keep the full perspective of what's going on here is what we're trying to see here. The full long-term perspective. So you have that first breakout, then you have your first base, another breakout. You can say this is another base. Again, doesn't look super significant in this grand scheme of this chart, but that's 6-7 months again where you're kind of sideways trading. Again, there can be money made in there on the short term, but on the long-term perspective of what's going on, that's a base. That's mostly sideways trading. You have a push back up to a next level. You see a pullback here. And again, just because we're in the markup phase doesn't mean there will not be any pullbacks. We have a pretty significant pullback here. As you see, this red line is a 20-day moving average, so it hits a significant level here with the 20-day moving average that happens to coincide with your previous base. It does not break below the base. It tests it pretty hard, but is able to hold up. That previous base level holds up, and then you see a next push up, another continuation of the markup. Then you get your top in here where it tries to break, can't keep breaking up, gets a little weakness, and now we start to see a decline. Stage 4, bear market. Okay, and you see it breaks through all of the not all, but as you see, it breaks through this previous base here. It breaks through this previous base here. So that's how you can tell we're in a stage 4, is that you'll actually start breaking through the previous bases. If those previous bases hold up, then you're not for sure, you have not confirmed that you're in the decline phase. So we have decline, we get a base here, that's our next cycle. So now this is our new cycle. Again, we have a 6, 7, maybe 8 month base here where it's range bound in a kind of a square or rectangular area of price. Breakout, uptrend. Get to the top where it reaches its top. This is a base. The way you confirm that it's actually into the decline is when it starts breaking through those previous bases. Here's a base, you see a break below that. Here's a base, it breaks below that. Okay, breaks even below, really, even the first stage one of that second cycle. It even broke through that. Okay, so then this would be your next base here, where it kind of finds a bottom, and then it goes into the next cycle. So this is basically like 2.5 cycles that you see here. And again, keep in mind, this is a monthly chart. This is about 20 years. So this goes back to 1992 all the way to 2011. So that's important to note because these phases, these cycles, play out over long periods of time. Now you can use the market cycles on shorter terms and you'll see microcosms of them. You might see a microcosm of a cycle in a 15-minute chart or an hour chart or whatever, or 4-hour chart. But the true cycle is seen on long-term scales, daily charts, weekly charts, monthly charts. Okay, and so that's important to keep in mind. Okay, as I said, you can look for cycles on shorter term bases, but you need to keep that long-term perspective in mind, and we'll talk a little bit more about that as we go along. All right, so now those are kind of examples. Now let's look at a real chart, and I have selected Netflix to look at for this purpose. So here we're in Thinkorswim now, and this is Netflix's actual chart over the right now. First one that we're looking at is a 10-year monthly chart, and just so you know, as I call out prices and stuff, you can see those here as I move along. So if I mention a price and you're like, where is he getting that price from? It's right up here. Okay, so this is Netflix's 10-year chart. On a monthly basis. So each candlestick represents 1 month of trading. All right, so here I think we have a pretty clear market cycle playing out. You start here, and we have what I would say is a clear base. Okay, the low on this base, as you see, is 754, and the high on this base is actually right over here with a high of 16.4. That's a $9 range from the low to the high. Now, on average, if you look at most of these candles, it's mostly in between like $9, $8, and like $12. Mostly in between that range. But point being is that it's range bound and it's mostly sideways. Okay, your first breakout is right here on this candle here. Okay, if you look at the top, the high on this candle is $25. So even from the previous high, which was $16, we've gone up, over 50% just on this candle, just on the first breakout candle. And then as that uptrend, that markup continues, we get all the way up to $65 high here on this candle. The high is $65. So in one markup, just the first leg of the markup, we've gone up, 400 or 500%. And as you can see, this is 1 year of time. This line here is 2012. This line here is this line here is the beginning of 2013. And this line here is 2014. So this first leg of the markup is 1 year, and we get basically a 400 or 500% increase. Okay. Now I mentioned that even on the markup, even on the stage two of the cycle, you will have bases. Okay, and that's what we see right here. After we reach that top of that first leg of the markup, we get a base. And as I mentioned, bases can last a long time. This is basically a year of a base where it's trading in a range, kind of mostly sideways. Okay, now, depending how many bases a stock has on the markup will depend on the quality of the stock. Netflix is what I would call a super performer or a super cycle. And on a super cycle or a super performer, which is the best stocks to identify, it's maybe the hardest stocks to identify, but when you're dealing with a super performing stock, you're going to have 3 to 5 bases on the markup in stage 2. Within stage 2, you'll get 3 to 5 bases. So this is our first base in stage 2 in the markup right here. We get a breakout from that base here, continuing the markup cycle. Okay, and we go from $59 open on this candle to a $80 close. So it goes up to $20 or 33% just in this month, and it continues up to a high here of $129. So again, another, after we already went up 300 or 400% here, we go up another 100% something here in this leg of the second stage. Then we get another year-long base. Okay, we get a breakout from this base here. Maybe you could, say here, but being that we had tops here, I would say the actual breakout is right here. And we push above the previous highs, and we get another uptrend. This uptrend, I would say, actually continues all the way to up here. Okay, and we go up another couple 100%. Now again, this is over a 1.5 year time span, but we've had 2 bases. One base here, a continuation, a base here, second base, a continuation. Now here, you might want to say, some people might say, well, this is stage 4. This must have been stage 3, the top, and the stage 4 decline. You could theoretically say that. Looking at this grand perspective, I would say I personally would consider this another base. The reason I would say that is because it just never breaks below a previous base. So as you can see, it did pull back, but it never broke a previous base that we formed. So if this, even if you say this is a base here, I'm not necessarily considering that a base, but you could theoretically call this area a base. Even if you called this a base, this never breaks below it. So for that reason, I would consider this the third base. It's stuck in a range. I'm going to highlight it just for... Sorry, hold on. I'm going to highlight this. It's stuck in a kind of rectangular zone of action. It's stuck in a rectangular range of trading. Now when I let go, it's going to zoom in, but I don't really want to do that. I was just kind of trying to highlight what I was talking about. So I would consider this the third base right here in this square. And then you get the breakout from that third base here. Again, a continuation upwards. This is a clear base to me, sideways track action. And then you get your, so this is base 4. This is your fourth base. Then you get a breakout, a final breakout here. And the top gets put in here. And then this would be a clear entry into a decline phase. Okay, we broke through the previous base rather quickly, I would say. And now we already are at the previous base, the top of the previous, this is if this is the previous base here, we're already broke through the first base, the last base, and we're already basically testing the base before that. So this is a clear entry into the decline phase to me. Okay. Now again, this is the monthly chart. Let's break it down to the weekly chart, 3 years weekly. Okay. So if you for context, where we're starting at here, the beginning of this chart, that is the same as this here. Okay, this is where we're starting at on the weekly chart. So it's going to look kind of like a stage 4 again. It'll kind of look like a stage 4 decline, but that's really part of that base. Okay, that's really part of that third base that we identified. And then we kind of get it back up, I would say the actual breakout from that base is right here. Okay, you break out, push all the way up to here. All right, that's that fourth base that we identified is all of this. And then we get the breakout from that base right here, right in this range. And then we break out here and we push up to our top. Again, this is weeks. So this is, basically a month of action here where it's kind of trying to stay up here. It's trying to hold up. It's trying to push a little higher, and it's unable to do so. And then we start getting the fall, the distribution, the decline, the markdown. Okay. Zooming in one more layer, we'll go to the day chart. Clearly the base here. Now this base here, just for reference, that's some of this. That's some of this here. We're in this range of what's happening here. Okay. So that's that last base that we identified. As you can see, it's kind of range bound within a relatively tight range of action. We get the breakout over here. Now, just because it pulls back a little bit doesn't necessarily mean that it's still not in that uptrend. Okay, so this is that whole last leg of the markup is from here all the way up to here. On the daily chart, it's even more clear that we're struggling here. Okay, we hit this 690 range. 1, 2, 3, basically 4, 5, 6 times. Okay. And then once we start to see that sell-off and the breaking of the previous bases, that lets us know we're entering into decline. Okay, so as I said, if we break it down further, this is the 4-hour chart. So this is only 6 months. This is a microcosm of a cycle. You have the base, breakout, base, breakout, base, breakout, base, breakout, top, coincidentally a double top here, 2 tops before it breaks down. And now we're clearly into the decline phase here. So it's important to keep your time frames in perspective here. As I said, you can see microcosms of the market cycle. Even if I broke down to 30-minute charts, 5-minute charts, 15-minute charts, you'll see microcosms of the market cycle. But the true market cycle is on these longer time frames. Okay, the true cycle is shown on these monthly charts, weekly charts, daily charts. Okay, so if you are a long-term trader, if you trade leaps, or if you trade options where you're holding, you have 6-month expirations, 8-month expirations, you're holding contracts for months, weeks at a time, you definitely obviously want to keep the long term in perspective. What's happening on the 15-minute chart and the 5-minute chart and even the hour chart aren't really that relevant to you, except for maybe the day that you're trying to buy it. On the flip side, if you're a short-term trader, you're primarily probably looking at 15-minute charts and 30-minute charts and 1-hour charts and 5-minute charts. Now, whereas the long-term trader doesn't really need to worry about the short-term charts, I would urge the short-term trader to still think about the long-term charts. Okay. Because they give you a reference for what, as I said, what is truly happening in terms of the long-term trend and the long-term cycle. So for instance, here we definitely are in a decline stage right here, stage 4. Now, say you're a short-term trader, a day trader or whatever, and you are in somewhere in these 3 days here. You might have been like, oh, well, this is, good money making. And it definitely could be. We went from, an open on this first day of 586 to on this last day, a high of 614. So that's like, $30 of movement. You definitely could make some money here. But if you got too greedy and you didn't keep the long-term trends of what's going on in perspective, you would have got real hurt if you held this contract too long. Okay, because you weren't paying attention to the long-term trend and the long-term cycle. Okay, so that's why I would say, even if you're a short-term trader, I urge you to consider and evaluate what's happening on the long-term perspective. Okay, because this is what we would call a bull trap. It makes us think, oh, okay, it's found a bottom. This is the bottom. We found a bottom. Obviously, this would not be here. If we're on this, if this was actually the days we were trading, none of this stuff would be here, and we would not know this was coming. So you might be tempted to think, oh, well, it found a bottom. Here's the bottom. Now we're recovering, and we're going to go right back up. But if you have this day chart, this weekly chart, and this monthly chart in perspective, you might be ready. You might be prepared. Well, it is bouncing, but I need to be mindful of the fact that we are in a downtrend. We're in a decline stage. And so I'm prepared for this pullback, and I'm protecting myself so that I don't get over greedy and then end up here wondering what happened and, being sad because I lost all my money. So I urge you, if you're a short-term trader, you still really need to keep the long-term things in perspective. Okay, so those are the 4 stages of the market cycle, and how time frames relate to them. The other thing I'm going to talk about just quickly, and Netflix is one of the reasons why I picked Netflix to look at, is because of this next thing I'm going to just talk about quickly, which is the 50-80 rule. Now, this is something I picked up from a guy named Mark Minervini, who is one of the best traders out there, super great trader. He's written a few books, made millions of dollars. And it's something he teaches that I picked up from him. And that is, well, first of all, I'll say the base counting thing I just told you about, I also got from him. Okay, so the fact that you can count bases on super cycle stocks, that's from I got that from Mark Minervini. Okay, and he's the one that said if it's a super cycle stock, you will have 3 to 5 bases. Now, not every stock is a super cycle stock. Okay, super cycle stocks tend to be market leaders. They tend to be emerging technologies, things of that nature, where they can really make super powerful moves. Now, maybe, and this is just an example. I don't know whether they would qualify or not as a super cycle, but for instance, maybe like a Coca-Cola or a Procter & Gamble, or something that's kind of been around for longer. They can definitely still have multiple legs on a markup, but I guess I would say it's less likely that they're going to have these 10-year 5 base markups. Maybe they have 1 or 2 or 3 bases on their markup. But just keep that in mind. Not every stock is going to have 3 to 5 bases on this markup leg of the cycle. That's kind of the exceptional stocks that have tremendous growth stories. Those are tremendous growth stories where they have that many bases. So it doesn't necessarily mean you're guaranteed 3 to 5 bases on the markup. Now, the second thing that I was going to mention that I got from Mark is called the 50-80 rule. Okay, and I think Netflix is a perfect example of it. And that is, it relates to secular stocks. Okay, so first let me explain secular stock real quick. A secular stock is kind of, you can think of that as the opposite of a cyclical stock. Okay, cyclical stocks have a large influence by seasonality and cycles. So you could think of air travel. There's obviously periods of time during the year where air travel is heavier than others. The summertime and the holidays, they get upticks in demand and action. Another one, you could say maybe Disney, for instance, with their movies. Blockbuster movies usually come out in the summer or in the winter, in the holiday season, Thanksgiving to Christmas time. Obviously, movies are made all throughout the year, but the biggest blockbuster movies are usually released during the summer and during the winter or the fall or the holidays. And so they get extra activity during that time frame. Sticking with Disney, you could think about their theme parks. Obviously, people go to Disneyland throughout the whole year, but they get significantly higher activity during summer season and holiday season in the winter, because kids are out of school and they're able to travel more. So those are examples of cyclical stocks. You could think of maybe agriculture. I can't tell you the seasons that all the different crops are grown, but they're planted in a particular season, they're harvested in a particular season, they're sold in a particular season, whether that be corn or cotton or soybeans or whatever the case may be. There's a cyclical seasonal element to them. So secular stocks are the opposite of that. There's not really a seasonal element to them. So these are often tech stocks, e-commerce stocks, things of that nature, where there really isn't a seasonal element to iPhone demand. They may get an uptick during the holiday because people are buying them as gifts or not, but there's not really a seasonal element of cell phone demand. There's not really a seasonal element to shopping on Amazon. Again, they might have a holiday special where they get higher traffic, but there's not really a seasonal element to them. Netflix is a secular stock. People use Netflix all year round. It's not really driven by season. I would probably say even healthcare is a secular stock. There's seasonal elements in terms of like the flu, and COVID is obviously like kind of an exception where there's like a particular period of something happening that's significant. But by and large, healthcare is healthcare. The main things that are long-term health issues, cancer and diabetes and heart disease and high cholesterol and things of that nature, and Alzheimer's disease, like the biggest health issues out there. There's not really a seasonal element to those. They just are, and they're constantly needing treatment. So that would be another example of secular. So the 50-80 rule, going back to that, is in reference to secular stocks. And what the rule says is that when a secular market leader puts in a top, a main top, like a significant top, which would be here, there is an 80% chance that the stock will lose 50% of its value. And there is a 50% chance that it will lose 80% of its value. Now, as I said, I got this from Mark Minervini. I will not sit here and tell you that I have actually done the historical research to verify that claim, but I believe it. I believe it's accurate. I've seen some of the data. I haven't, done the research myself, but I've seen some of the data. I find it, reputable. If you want to do more digging, obviously, to see whether or not it holds up, feel free to do so. But I think it's fairly true, and I think we've seen that with the .com bust, things like Amazon in the late 2000s. This happened across the internet stocks. They dropped 80%, at 50% at the minimum, 80-90% sometimes. Some of those dropped. So I think there is evidence that it's accurate. So with a secular market leader, the 50-80 rule states that there is an 80% chance that it loses 50% of its value and a 50% chance that it loses 80% of its value. So just in the context of Netflix, as we can see here, the top was $700. Well, already, just in these 3 months, we're down to $397. And the low is $379. So we almost have already got to that 50% loss of value. Okay, so as the rule said, there's an 80% chance that it loses 50% of its value. Well, that's already almost happened for Netflix. Okay, it says there's a 50% chance that it loses 80% of its value. So if it lost 80% from the top, let's say that would be like $140 basically. So that means we could theoretically get all the way down here. Okay. Now, that's not a guarantee that it has to, but like I said, there's a 50% chance that it can get this low, which means we could just be getting started on the drop on this decline phase. Okay, now to put that in perspective, just 10 years ago, this was trading for $7, $10. Okay, so even if it did pull back to $140, that's still, I think like over 1,000% increase in 10 years, even if it dropped to 140. I don't know if that math is 100% correct, but it's definitely several 100%. Even at $140, it's still a several 100% gain from 10 years ago, if not like 1,000 or something percent. So take that for what it's worth. If you want to do more research on that, feel free to do so. But just thought it was something I would share. I thought it's particularly relevant in light of the market cycles that we're talking about in this video. So I just felt like I would share that with y'all. Let's see. So then I guess the other thing I was going to say would be, the last piece I had on this was a piece of evidence that you can use to see whether the pullbacks are true or whether they're going to fully break. How do I know what is something I could have looked at right here to tell me whether this was actually entering a true decline phase or whether this was just a quote unquote bear trap. Okay, so bear trap is when things fall, but it's just buyers waiting for their opportunity to push it further higher. Okay, a bull trap is the opposite. When we let it pump. We saw that on, where do we see that? Was it on the day chart? This here is a bull trap. Okay, we see an increase and the bulls think that, hey, okay, we found the bottom, we're about to bounce and go higher, but it's really just sellers. They're sellers backing off, letting you push the price up so that they can sell it at a higher price and then push it back down. Okay, so what are some clues as to how we can see whether a move is real or not? And the thing I would point to is volume. Okay, so on this monthly chart, I think it's a good way to look at it. You can see, look at this pattern of this volume here. From the beginning of the cycle to now the decline phase, you can see a consistent decline in volume. It's almost like a perfect triangle going down in volume. So what you have here, in order to have sustained high volume like this, you need institutional investors. Retail investors might be able to push you up, a high volume for a day or two or even a week or whatnot. They are not going to be able to push up the volume over years like this. This is multiple years of high volume activity here. That means institutional investors. And institutional investors are what start markup phases. Phase 2. Phase 2 is the catalyst for phase 2 is institutional investors loading up. Okay, so that's what you see here. You see high volume, and that gives us a signal that we are going into a markup phase. Okay, now as the further you go, obviously the volume is declining because the institutional investors loaded up back here. And now at this point, there's less institutional investing. Now you can still use volume as a key because once the institutional investors have loaded up back here, it now requires less volume for me to push the price up because the institutional investors here have bought up all the sellers. They have bought out all the sellers here. And so now it's just institutional investors holding this stock and they're waiting and they're going to sell it into strength here as it goes up. Okay. So that's why we see it still pushing up even though the volume is dropping. Now the key here is the volume higher when there's buying going on, or is the volume higher when there's selling going on? So as long as I'm getting higher average volume on my green days than I am on my red days or my red months or my red weeks, whatever the case may be, then that means I can have a significant amount of confidence that I'm still going to continue in my markup. If the volume on my green days, if the volume surges on green days, and when it's a red day, the volume is actually small relatively to the recent averages, then I don't need to panic sell. Now, if I get a big kick in volume, as we see here with the selling, that might be a worrisome signal. Okay, so that's how you can use volume to say, okay, is this pullback going to break through my previous levels? Well, how high is the volume? Is the volume increasing or is the volume decreasing? If it's low volume selling, then you can have confidence that it's going to continue up. If it's high volume selling, then you need to be mindful of that and say, okay, well, the selling is picking up. There's more sellers coming in. I need to think about whether I need to protect myself in that scenario. Okay. And vice versa. If something is in a downtrend, when there's a green day, let's see what that looked like on that day chart. Okay, so see here, you see these days here where we said, oh, maybe we thought we got a bottom. Maybe we think we found a bottom and it's getting ready to bounce. Well, look at the volume down here. The volume on these days is low compared to the red days. It's in the midst of. Okay, so that is a signal that, hey, this might be a bull trap. Yes, it's bouncing, but it's on low volume at this point. Lesser volume than the selling going on around it. Okay, and so then you see here, the volume really kicks in. Now the volume's increasingly, it's every day it's increasing basically. The amount of selling is increasing. Okay, so that's kind of a way you can use volume as a indicator as to whether a move will stick. If the green days have higher volume than the red days, you can have a degree of confidence that the uptrend will continue. If you're in an uptrend, if you're in an uptrend and the red days start to have a higher volume than the green days, then you need to consider that and be like, okay, well, we might be getting ready for a significant pullback. Vice versa, if you're in a downtrend and the green days volume is lower than the red days, you can have confidence that the downtrend is going to continue. Whereas if the volume on the green days kicks up and starts getting higher than that of the red days, you might be like, okay, well, maybe we did really find a bounce. Maybe we're a bottom and we're getting ready for a bounce. So with that, I think I'll stop it right there. Hopefully this was helpful to you guys. I know some of y'all are probably already familiar with the market cycles, but if you are, hopefully you heard something that was new or clarified something or helpful to you. And obviously, if you didn't know anything about the market cycles, hopefully this is a good introduction to them for you. I'm gonna post this in the group, and please feel free to chime in with your thoughts and questions. You can write me with your questions, or you can post them in the group. I would strongly prefer you post them in the group so that everybody can see them and we can have a collaborative dialogue about them. But you know, whatever floats your boat is fine with me. But with that said, thank y'all. I'm gonna do a second video here, which will be shorter than this one, which will be on finding levels, key levels. That'll kind of accompany this. They'll kind of go hand in hand, and I'll post that one up shortly. So thanks guys, and I will talk to you soon.